stock market is trembling. Red dominates the charts. Alarming headlines flood in. Financial crisis incoming. Recession cycle has begun. And like millions of investors, you're wondering, should I pull out or push forward? But wait, don't panic just yet. History shows that the bloodiest moments in the market have birthed the greatest investors. In this video, you won't just understand why the market crashes, you'll learn how to turn it into a launchpad for wealth. This isn't theory, it's a survival strategy. If you want to thrive while others retreat, this may be the most important guide you'll hear all year. Let's dive in. Understand why markets crash and discover how to turn chaos into your greatest financial advantage. What causes the stock market to crash? The stock market is a playground of dreams and fears. One day, prices plummet without warning. The headlines scream doom and panic sets in. But instead of reacting emotionally, we must ask, why does this happen? Market crashes aren't random. They are the result of psychological triggers, economic shifts, and structural weaknesses. To master investing, you must go beyond surface reactions and study the roots. When you understand why crashes happen, you're no longer a victim of panic. You become a strategist, capable of turning storms into stepping stones. Knowledge is your shield in the battlefield of finance. The first cause, bubbles bursting. When greed overtakes reason, stock prices skyrocket based on hype, not real business fundamentals. People buy because others are buying, fearing they'll miss out. But every bubble has a breaking point. Once the crowd realizes the truth that many of these companies are overvalued or unsustainable, they rush to sell and the entire market collapses. These bubbles are inflated with blind optimism and burst with brutal reality. The takeaway? Hype is dangerous. A booming price without true value is just a time bomb with a fancy label. The second cause, economic downturns and misguided policies. When inflation spirals, prices for essentials skyrocket. Consumers tighten their wallets. Companies report lower profits. Investors react by dumping stocks. Meanwhile, central banks may raise interest rates to fight inflation, making loans more expensive and shrinking business growth. This chain reaction intensifies the downturn. Recessions often go hand in hand with market crashes. What starts as a slowdown can become a free fall if the fundamentals keep weakening. The economy doesn't crash overnight. It cracks slowly, then collapses all at once. The third trigger, black swan events. Unexpected shocks like pandemics, wars, terror attacks, or financial frauds. These events inject fear into every corner of the economy. Because humans fear uncertainty more than loss, they sell their stocks in haste. This rapid sell-off causes prices to plunge, regardless of logic. A striking example, the COVID-19 pandemic. In just a few weeks, markets worldwide dropped over 30%. Not because businesses failed overnight, but because fear spread faster than any virus. In times like these, fear, not facts, drives the market. Beyond those core causes, there are accelerators. Excessive leverage, forced margin calls, and herd behavior. When one investor sells, others follow, not based on logic, but fear of being the last one holding the bag. This creates a snowball effect. Small drops trigger larger ones, and soon, the whole market is in a panic. Crashes often aren't about fundamentals. They're about momentum fueled by emotion. Once you realize how crowd psychology works, you stop reacting and start positioning. Calm minds profit when chaos rules. Here's the truth. Markets don't crash on their own. They collapse because humans let fear, greed, and poor decisions control the game. If you judge the market solely by the color red, you're missing the bigger picture. Ask deeper questions. Think independently. Don't just follow the noise. Read between the lines. The best investors aren't those who avoid every crash. They're the ones who understand them and thrive because of that understanding. Master the why, and you'll master your financial destiny. Are stock market crashes normal? Expecting the market to always rise is like expecting sunshine every day. It's naive. Just like weather, markets breathe. They rise and fall. Crashes aren't anomalies. They're part of the system. Don't see them as endings. See them as pauses, recalibrations, corrections that flush out excess and prepare the ground for future growth. If you embrace the rhythm of the market, you won't fear the red days. You'll be ready for them. Understanding the nature of market cycles is step one toward financial resilience. History proves it. Markets move in predictable patterns. Pullbacks of 5 to 10% happen almost every year. Corrections of 10 to 20% occur every 1 to 2 years. Bear markets, declines of 20 to 40%, show up roughly every 5 to 6 years. Crashes of 40% or more, once every decade or two. Yet what's remarkable is that every single crash has been followed by a recovery, and not just a bounce back, but often a surge to new highs. The pattern is clear: fall, recover, rise. Crashes don't destroy wealth for those who understand the cycle. They create windows of opportunity. The 1987 crash saw markets drop 22% in one day, yet full recovery came in 2 years. The 2008 crisis slashed the S&P 500 nearly 50%, but the market roared back within 4. COVID-19, a 30% plunge in 5 weeks and a full rebound in just 4 months. These stories echo the same lesson. Volatility is temporary, value is eternal. Investors who endure the storm are the ones who ride the next wave of growth. Fear is expensive, patience pays. So when should you worry? Not when prices drop, but when the economy collapses. Bank failures, massive unemployment, frozen cash, national defaults. These are rare, but they are red flags. Most of the time, however, crashes are not catastrophes. They're cleansing fires that burn off speculation and prepare the market for real growth. If you're investing in stable economies with active policies and functioning institutions, odds are the crash is just a chapter, not the end of the book. Seeing crashes as normal is your first step towards strength. Once fear fades, you'll start spotting opportunity. Wise investors don't ask, "Why is the market falling?" They ask, "How much lower can it go before I buy more?" That mindset turns you from a victim into a hunter. Don't resist the waves, learn to ride them. Every crash wipes out the unprepared, but elevates those who planned ahead. The market rewards courage wrapped in knowledge. Common mistakes during a stock market crash. When markets bleed, most people don't analyze, they react. The default response? Panic selling. Investors rush to cut losses, thinking they're protecting themselves. But here's the truth. A loss isn't real until you sell. If your investment is in a strong, fundamentally sound company, there's a high chance it will recover. By selling at the bottom, you're locking in failure. Smart investors stay calm, focused on long-term vision. Emotions are expensive. Strategy is priceless. The ones who win aren't the ones who move fastest. They're the ones who move wisely. Don't let fear rob you of future fortune. Another trap, trying to time the bottom. Everyone wants to buy at the lowest point, but nobody knows where that is. Waiting too long? You miss the boat. Jumping in too early? You might ride more pain. The better path? Dollar cost averaging, DCA. Invest a fixed amount regularly, no matter the price. You'll buy more shares when prices are low and fewer when high, averaging out your cost over time. DCA removes pressure, tames emotion, and builds wealth steadily. Timing the market is a gamble. DCA is a system. Consistency beats precision every single time. Don't fall for cheap traps. In a crash, prices drop across the board, but not all dips are deals. Some companies are falling for a reason: poor management, bad balance sheets, or unsustainable models. Buying them just because they're cheap is like buying expired food just because it's on sale. Focus on quality. Look for companies with strong earnings, low debt, and a track record of surviving downturns. Great businesses go on sale during crashes, not broken ones. Investing isn't about what's cheap, it's about what's worth owning long-term. Cheap junk stays junk, no matter the price. Another deadly mistake: lack of diversification. Many investors go all in on a single stock or sector. When that segment collapses, their entire portfolio goes with it. That's not investing, that's gambling. Smart investors spread risk across different industries: tech, healthcare, consumer goods, and even international markets. Diversification acts as your financial shock absorber. It doesn't eliminate risk, but it cushions the blow. If one part of your portfolio struggles, others may hold steady or even rise. Don't let one bad bet ruin your journey. The smartest move is to never put all your eggs in one basket. Finally, beware of FOMO, fear of missing out. When everyone's panicking, you panic. When media screams doom, you believe it. But remember, even top Wall Street pros can't predict the market perfectly. Don't follow the crowd. Don't let hype or hysteria drive your decisions. Learn to think for yourself. Understand what you invest in and why. Blind following leads to blind losses. If you're unsure, talk to a financial advisor, but always understand your investments. As one legend said, never invest in something you don't understand. In a crisis, clarity is your best defense. How do investors profit from a stock market crash? While most people run for cover during a crash, the wise prepare for battle. For them, a market downturn isn't a signal to retreat. It's a once-in-a-decade opportunity to build wealth. When great companies trade at fire sale prices, smart investors strike. A crash doesn't erase value, it discounts it. If you've done your homework, if you believe in the long-term potential of your investments, then this is your moment. This is where fortunes are made, not when markets soar, but when they stumble. The brave don't wait for the skies to clear. They invest while thunder roars. But what should you buy? Not everything. You want companies with strong fundamentals, consistent revenue, solid cash flow, low debt, experienced leadership, and a history of resilience. Don't guess. Study their earnings, market position, and business model. Have they survived previous downturns? Are they leaders in essential sectors? If yes, then they're likely to rebound and thrive post-crash. These are your financial fortresses, built to withstand storms, not castles of sand waiting to wash away. Value doesn't vanish during a crash. It hides, waiting for those sharp enough to find it. Think picking stocks is too complex? You're not alone. That's where dollar-cost averaging DCA becomes your superpower. By investing a fixed amount at regular intervals, you average out your cost regardless of market swings. When prices fall, you get more shares. When prices rise, you get fewer, but your pace stays steady. DCA isn't flashy, but it works. It silences the noise and removes the pressure of perfect timing. If the business is strong, DCA ensures you build your position steadily, without fear, without hesitation. Momentum builds not from guessing, but from consistent, disciplined action. Let's look at a real example. Amazon in 2008. Before the crash, it was trading near $90. With $1,000, you could buy 11 shares. During the crash, it dipped below $40. You could now afford 25 shares for the same amount. If you believed in Amazon's vision and held on, those 25 shares would have grown to over $75,000 by 2021. That's an 8,000% return. And it didn't come from brilliance, it came from boldness in chaos. Crashes are where conviction meets opportunity, but only if you're brave enough to act while others hide. Not ready to pick individual stocks? No problem. That's where ETFs and index funds shine. These diversified baskets let you invest across the entire market or a specific sector with just one purchase. During a crash, they drop too, but that just means you can buy a lot of value at a discount. You're not betting on one company, you're buying into broad recovery. Low fees, built-in diversification, and long-term growth make ETFs ideal for both beginners and veterans. Crashes become less intimidating when you hold the whole battlefield, not just one soldier. Investing is not a race to riches, it's a marathon of meaning. What separates wealthy investors from weekend traders isn't IQ, it's resilience. While others scream, they study. While others flee, they accumulate. The truth is, wealth isn't built during bull runs, it's built in bear markets, silently, patiently. You don't need superhuman timing, you need calm in chaos. Every dollar invested during a crash becomes a seed in fertile soil. Plant it with faith, water it with time, and one day, you'll wake up to a forest. So don't fear crashes, prepare for them. Build your watch list, do your research, strengthen your mindset. When others panic, you'll already have your strategy in place. Crashes are not punishments, they're filters. They separate the emotional from the educated, the short-term thinkers from long-term builders. Ask not, when will this end? But am I ready to act when the storm hits? Because when the dust settles, only two kinds of investors remain. Those who sold out and those who leveled up. Which one will you be? Short selling and defensive strategies. Most investors focus on buying low and selling high, but some take the opposite path. Short selling. It works like this. You borrow a stock, sell it at a high price, then buy it back at a lower price to return it, pocketing the difference. Sounds clever, right? It can be, but it's incredibly risky. If the stock price rises instead, you're forced to buy it back at a higher price, taking a loss with no limit. While short selling can generate massive profits for professionals, for most, it's a trap disguised as a tactic. Handle with extreme caution. Short selling isn't evil, it's just not beginner-friendly. It requires deep research, fast reactions, and a stomach for volatility. One wrong move and losses spiral. For most investors, defense means discipline, not danger. Protect yourself not by betting against companies, but by managing risk smartly. Keep cash reserves. Build a watch list. Focus on sectors that perform well in downturns, like utilities or healthcare. Recession-resistant stocks can stabilize your portfolio when others falter. In tough markets, staying standing is a win. You don't always need to attack. Sometimes the smartest move is holding your ground. Want the best defense? Diversify like a pro. Spread your investments across different sectors, geographies, and even asset classes. Stocks, bonds, commodities, ETFs. That way, when one area drops, another may hold firm or rise. Also, maintain liquidity. Keep a portion of your portfolio in cash or stable funds so you can act when opportunity strikes. Crashes don't reward the biggest risk takers, they reward the best prepared. Your goal is not to beat the market in every move. It's to stay in the game long enough for your strategy to work. Stay flexible, stay protected, and stay in control. At the end of it all, remember this: crashes are not the enemy, ignorance is. Every single downturn has two outcomes. It either breaks those who panic or builds those who are prepared. The biggest difference between losing it all and gaining everything lies in how you respond. Do you run or do you rise? The market doesn't reward fear. It rewards clarity, courage, and consistency. Those who understand the cycle don't just survive, they thrive. If you want to win this game, stop fearing red days. Start preparing for them, because those who are ready rule the rebound. The real battleground isn't the stock chart, it's your own psychology. Patience, not predictions, wins over time. The market isn't beaten by brains, it's beaten by behavior. Fear makes people sell low, greed makes them buy high, but discipline builds wealth. When everyone else sells in panic, you accumulate in confidence. When the world doubts, you double down on your research. Wealth isn't about being lucky in bull markets, it's about being resilient in bear markets. Build your emotional armor. Study when others sleep. Act when others hesitate. That's how legacies are made. Here's your 4-pillar strategy. The first, invest in great businesses with real value. The second, use dollar-cost averaging to ride through volatility. The third, diversify wisely across sectors, countries, and asset types. Finally, never invest in what you don't deeply understand. That's it. Master those 4 rules and you'll outperform most investors without needing to time the market, follow hype, or predict the unpredictable. Simplicity is strength. Repetition builds results. Stay consistent, stay curious, and stay grounded. You don't need to chase magic formulas. You need a system you can stick to, even in chaos. So don't fear the next crash. Train for it. Build your portfolio like an architect, not a gambler. Use every drop in price as a discount on your future wealth. Stay liquid, stay informed, stay fearless. When others retreat, you'll advance. When the world panics, you'll plant seeds. And when the storm clears, you won't just have survived, you'll have grown stronger, richer, and wiser. A crash is not the end, it's an invitation. The question is, will you hide from it? Or will you walk through it like someone who knows exactly where they're going?